Brought to you by Raisin UK, the smart choice for savers who want strong returns without the legwork. What's more, for a limited time only, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link below or go to raisin.co.uk/PensionCraft. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
The S&P 500 is back at .com era valuations. Bitcoin smashing records. Meme stocks have risen from the dead, and AI startups with no product, just buzz, are landing billion-dollar buyouts.
What do you do when a bubble is staring you right in the face? And in today's dumb question of the week, what is a gamma squeeze? All right, let's get into it. So, Romin, as we know, it's pretty dangerous to talk about bubbles because they're notoriously hard to diagnose in real time. There's no real 100% accurate indicator. But I feel we have to talk about it because just in the last few days, I've seen so many headlines in the media. In the FT, we had Wall Street's euphoria sparks bubble warnings. In the Wall Street Journal, 5 signs of a market bubble investors are tracking. And if you go on Twitter or Blue Sky or any of those social media apps, you're just bombarded with graphs, inevitably with dotted lines going back through the decades, showing that by various measures, we're above where we were in the dot-com bubble, we're above where we were in like 1929, and everyone's going, surely this is a bubble.
Look, you're right. I think all of the signs are pointing to us being in a bubble, but the question is always, what should you do about it? And the answer is usually absolutely nothing. And the reason for that is that you can't get in and out in time. If there is going to be a popping of the bubble, I almost guarantee that you won't be able to spot it in time, or there'll be all sorts of things which stop you from selling when you should. So this is why I'm a hodler. I buy stocks and I don't sell them. I just hold on to it, and I'll only sell them when I don't need them anymore or I need the cash.
So it sounds like you're pretty convinced that whatever we mean by a bubble, we might be in it. Should we just run through some numbers to make the argument for that? I mentioned these graphs where you get the dotted lines going back through history. One such thing might be the Shiller-Cape ratio, which is the cyclically adjusted price-to-earnings ratio. Do you want to explain what that is, Romin?
So you take the price of the index or a stock today and you divide it by the profits over the last 10 years. Why 10 years? Well, it's roughly one business cycle. And so you are kind of smoothing over that business cycle. So it tends to be less noisy on the denominator side of it. But this has been a very good spotter of bubbles in the past. For example, there was a huge peak in it in 2000. There was another huge peak in it just before the big sell-offs in the 1930s.
But it's not flawless, like it wouldn't have identified the financial crisis, for example.
No, that's right. It doesn't always peak just before a big sell-off.
But it is peaking now, that's the point. So the value is around 38, approaching 40. And that is higher than it was in 1929, before that big sell-off. And it's not far off the 2000 dot-com era peak. It looks like it's in the 97th percentile of history. So that would be saying things are expensive, it looks like a bubble.
And even if you look at the modified version of Shiller's Cape ratio, which is Shiller's excess Cape yield, where you adjust for real interest rates, that also shows that US markets, equity markets, have been cheaper about 80% of the time.
And I guess the key point with this Cape ratio is that it has identified some bubbles in the past. And what that means is bubbles pop. And over the next 10 years, the return you get from equity markets tends to be relatively low compared to other periods. So if you took it from the peak in 1929 or 2000, the 10-year real return on American stocks after those peaks in Cape would average around minus 3% per year.
But as you say, it's a very noisy indicator. All indicators are noisy. There isn't any kind of infallible indicator. Another one you might look at is the forward price to earnings multiple. So here we're looking at forecast earnings. And again, it's looking very expensive on that measure. So as of July the 25th, 2025, the forward price to earnings multiple for the S&P 500 was 22.4. Now the 5-year average is 19.9, the 10-year average is 18.4. So even by recent expensive standards and norms, that's looking expensive. Now that tells me there's euphoria.
pretty much any measure you look at is going to say American stocks are particularly expensive right now. So you've compared it to earnings. We've looked at the history of earnings with Kate. We've looked at the expectations for earnings with the forward PE ratio. But even if you forget about earnings and just look at sales, the S&P 500 is trading at 3.3 times their sales, which is an all-time high. It's never been that expensive compared to the revenue they generate.
And just in case you were wondering, we do have another measure. So equity risk premium is a useful one, actually, because this is the return that you should expect for a given market above the risk-free rate. So if 10-year yields in the United States for US Treasuries are 3% and the risk premium's 4%, then you're going to earn 7% in total.
But it's always an estimation, isn't it? You can't observe the equity risk premium directly.
Oh, yeah. If you ask 10 different quants, they'll come up with 10 different numbers. But certainly it's looking depressed right now. The numbers actually vary. According to the Wall Street Journal, a recent article, the equity risk premium is close to zero.
In which case, why would you buy stocks over the safety of bonds if they're going to give you the same return?
Exactly. And that's why I think it's got people a little bit spooked, because if that's the case, then you're probably thinking, I feel a little bit exposed right now. And as someone who's got 100% equity in their core portfolio, I feel that way very much. So I've been laughing with clients, they've been saying, look, I feel so scared at the moment because I'm worried that markets are going to fall. And I just look them in the eye and say, yeah, me too.
Do you really feel scared though? Like, I don't feel that right now. I'm in that complacent bucket where I'm like, the number's going up. Feels good. Even though in my heart, I know this isn't going to last, probably.
Yeah, I do feel scared. And, I don't panic about it. I don't sweat at night about it. It's just something which makes me feel uncomfortable. Because what's happened is that prices have got ahead of profits. Profits have grown hugely in the US, which is the most important market, but prices have grown even more quickly. And that doesn't last forever.
And if we look at which prices, like which stock prices are going up most quickly, at the moment, there's a trend which is not that comforting, which is we're seeing companies where they don't have any profits. Their prices are surging. So Goldman Sachs has an index of unprofitable tech stocks. And if you look back in time, that really soared in the mania of 2020, then crashed through 2022. It's going up again. It's jumped 60% in the last 3 months and has reached the highest level since early 2022. People are starting to speculate on these speculative companies again.
And one of the bellwethers of euphoria is always cryptocurrency, and Bitcoin's pushing all-time highs at the moment. So I think that's further evidence that we've got a lot of euphoria in the market right now.
Weirdly, I think you could make the case for maybe the first time ever that the strong rally in crypto is due to kind of fundamentals. Like if you see the legislation that's getting passed in the US, it's very crypto friendly. 3 bills went through Congress in the last few weeks, which is encouraging a kind of institutional adoption. So I know crypto doesn't have fundamentals, it doesn't have profits, but there is actually something tangible changing there, at least, which you could say, okay, well, maybe that's justifying the number going up.
And I've got a kind of pseudo valuation measure for crypto, for Bitcoin, which is to look at 3 times levered NASDAQ and compare the value of that to Bitcoin. And currently it's looking toppy on that measure. It has got slightly ahead of that measure. Depends on the period you look at.
Why would you compare Bitcoin to 3 times levered NASDAQ?
Because they're actually highly correlated with one another. If you look at the historic returns of the two, they're very similar.
Any theories about why that might be the case?
I think it's very similar people who buy them. I think if you look at the typical crypto buyer, they'd also be the kind of person that would buy Microsoft stocks, Nvidia stocks, Google stocks. It's the same mindset, the same set of investors, and the same drivers.
It's interesting if it's the same set of investors, because then you might think Bitcoin and the NASDAQ are competing with each other for money from the same people and might not be correlated. But I guess we're saying these investors are doing the sensible thing and diversifying across NASDAQ and Bitcoin, which provides no diversification, really.
But I always think it's worthwhile doing this and looking at what is correlated and what isn't, because that tells you whether you're diversified or not. Another worrying development is that lots of companies are copying the model which Strategy, previously MicroStrategy, has adopted, which is to take its excess cash and store it as Bitcoin. But Strategy's taken it to a whole new level, and they seem to have discovered this infinite money glitch. While the music's playing, of course, that still works. But people are willing to pay a premium for the Bitcoin which is held by Strategy. And because of that premium, whenever they issue new stock, they can make huge profits because of their Bitcoin holdings. And then they go off and buy more Bitcoin.
Yeah, what could possibly go wrong? I mean, you maybe undersold it when you said companies are taking their excess cash and parking it in Bitcoin. As I understand it, it's a little bit more leverage than that. They're issuing debt to go and buy Bitcoin or issuing stock to go and buy Bitcoin. As you say, because on their balance sheet, bizarrely, Bitcoin appears to be worth more than it is in the hands of you and I.
At least for now. And of course, the people who've done this by borrowing are at a much bigger risk than the companies which are equity funded, like Strategy, which doesn't have a lot of outstanding debt. So other companies that are using this approach would be Mara Holdings, 21 Capital, Riot Platforms, Metaplanet, Galaxy Digital Holdings. There's a whole bunch of them.
Trump Media.
Indeed.
Do you think there's been a shift in the crypto market at a high level over the last few years, where it used to be about all these different coins, these altcoins, and now it seems to be really, really focused on Bitcoin?
I guess it was always focused on Bitcoin. If you look at the market cap for Bitcoin, then it's always been much larger than the second largest, which is Ethereum.
Do you think Bitcoin and crypto more broadly has a place in the portfolio now, a small place? Is it institutionalized enough that if you're looking for a broadly diversified portfolio and you've got stocks, you've got bonds, you've got maybe gold, you've got commodities even, should you now be thinking, would it now make sense to have a small allocation to Bitcoin?
As long as you realize what you're buying is a leveraged version of the stock market, yeah. If you buy it because you think it's an inflation hedge or a hedge against your equity holdings, well, clearly that's misguided. Also in the UK, I think it'll be much easier once we get approval for exchange-traded funds, which give you exposure to Bitcoin, because then you'll be able to put it in your ISA and your SIP. At the moment, you're going to have to pay huge capital gains taxes, and it's always difficult getting it off one of these digital exchanges. I think that's a real problem with cryptocurrency, which is how to store it safely and also how to get your money onto the exchange and off the exchange.
Is it a sign of a bubble that you and I, two noted crypto skeptics, are saying, well, should it be in our portfolio now?
Well, no, I've been playing around with it for ages because many of our members bought it and I wanted to learn about it. And I have kind of enjoyed it. It has been incredibly volatile. I don't have a lot, it has to be said.
But I think it's fair to say that for once, crypto is not the most speculative part of the market. I think after the break, we'll come back and we'll talk about all those other signs that retail investors may be getting ahead of themselves.
Sorting your savings shouldn't mean juggling websites or doing hours of research. Raisin UK streamlines the whole process. With one login, you can explore and manage savings accounts from across 40 plus FSCS-protected banks, all in one place. What's more, for a limited time only, you can receive a £100 bonus when you register and fund your first savings account with a minimum of £10,000 using the code SAVINGS100. For more details, please visit the link below or go to raisin.co.uk/PensionCraft.
Okay, I think the time has come to talk about the return of meme stocks. We wrote about it last week in the newsletter, and it was a lot of fun to write. I do like it when meme stocks start surging.
I just love the acronyms. So for the latest round of acronyms and stocks which are exciting to these people, we now have DORK, D-O-R-K, because those are the first letters of the tickers for these four stocks. DNUT is Krispy Kreme, Open is Open Door, RKT is Rocket Mortgage, and KSS is Coles.
Now that might seem a pretty random collection of stocks there, right? You've got a donut maker, a department store, a real estate platform, and a mortgage lender. And you've also got some other stuff as well, like I know GoPro's been surging, and American Eagle later in the week. This might seem like a really random collection of companies, right? So what ties them all together? What is the making of a meme stock?
Firstly, I think it does have to have some kind of visibility. People have to be aware of the brand. And usually it's a brand which is faded, which was popular in the past.
I think that was definitely true, wasn't it, in 2020 when we had AMC, which is a cinema chain, and we had most notoriously GameStop, which I think a lot of very online people who used to love video games or still love video games, they used to buy their stuff at GameStop and now they no longer did. And they thought, well, that's a good stock, isn't it? Despite the fact it's obviously losing loads of money.
And Hertz, I think, last time around. Well, this time around, it's a similar thing. Krispy Kreme, for example. Many nerds, such as myself, would have a fondness for donuts. The second element is that lots of hedge funds have shorted the stock. Now, that means that if there's lots of buying, then it's going to push up the price. Lots of people will close out shorts. That involves buying, and that pushes up the price further. So you get this spiral of buying due to the short positions, which seems counterintuitive.
Yeah, let's unpack that a little bit more. So I think what tends to happen is there's some magic alchemy on Wall Street Bets, which is a Reddit forum, or social media, or another platform where lots of people are looking, and for some reason, one stock gets chosen. There might not even be a great reason for it. Like you say, it might be a nostalgic brand. Someone's made a funny post and everyone goes, oh, let's jump on this bandwagon. If we all buy it, the price will go up. But there's this added element, isn't there? If a lot of institutions, hedge funds, have shorted the stock, i.e. they think the price is going to go down, they can kind of be bullied into buying the stock, right? That's the weird mechanic behind it.
Think of a visual metaphor here, which is you've got a snowball and you throw it off a mountainside in Switzerland. Because you've got the institutional money behind you, which is effectively what you've got with the hedge funds, your snowball, which is the retail money, picks up the additional snow offered by the hedge funds. And that's what really pushes up the prices.
Should we just put ourselves in the shoes of a hedge fund right now who's shorted a stock? Maybe we've shorted Krispy Kreme because we think with all these weight loss drugs, no one's going to be buying glazed donuts anymore. So what we've effectively done is we borrowed the stock and then sold it, and we will profit if the price goes down.
But then what would happen if the price went up sharply? Well, now you're in trouble because you're bleeding money every day, plus you're having to pay to borrow the stock. So all round, it's a really painful trade, and you have to close it out at a certain point in order to cut your losses.
And so you have to buy it back, which is where you say this extra buying comes in.
Exactly. So that's where the extra snow comes from. It's the buying from the hedge funds who've shorted the stock and who are closing out their shorts.
And in 2020 with GameStop, this seemed to be an incredible phenomenon because somehow more than 100% of the stock appeared to be shorted. So there was really no way for them to exit the trade, right? And then we got controversial things where the regulators paused buying of the stock and kind of allowed the hedge funds to exit. I mean, they lost a lot of money, but it didn't bring down the collapse of financial markets, as some people speculated.
However, it did very well for Citadel, which is a hedge fund after all. So I'm not sure that sticking it to the hedge funds was the outcome that many people thought it was.
I mean, most people lost money, right, in the meme stock phenomenon of 2020. So why are they piling back into it now?
Maybe they think that this time they can time it correctly.
Yeah. And I have seen some talk online. You know, I like to occasionally go on Wall Street Bets and just see what people are up to. I think there is a cohort of people who genuinely feel there's a turnaround story here, like Krispy Kreme could save itself. And American Eagle, which is a fashion brand, last week they did this ad with Sydney Sweeney, famous Hollywood actress, posing alluringly in jeans, went viral. People go, well, maybe this is enough to turn around the brand.
But this is the way it was last time. If you looked at Wall Street Bets last time around, they had these due diligence posts where they talk about the fundamentals of the company. And it actually read pretty well if you read the reports. I thought they were quite convincing. But of course, you can always make a case if you're a good strategist for one way or the other using the same data.
And I think it's worth acknowledging that, like we say, it didn't work out great last time for the investors or for the companies, really. GameStop's down 70% from its peak in early 2021, though it is still above the level of before that meme stock mania, whereas AMC, the other main company at the heart of it, that's down like 99% from the peak, and Bed Bath & Beyond, which was another meme stock of the time, is actually bankrupt now.
But what we're talking about here is the exact opposite of investing. Investing is taking a long-term view and not expecting huge returns, but getting reasonable returns over a long period of time. Gambling is about trying to find stocks which surge in value short term. And that's exactly what this meme craze is.
And thinking you can actually get them to surge in value because of this bandwagon effect and the short squeeze. And you can print money, right? That's the theory.
And if you haven't seen the documentary about this, I really recommend it. It is quite entertaining, but it gives too much of a positive spin, I think, on the guy who is primarily behind it, who's Roaring Kitty. And the name of that show is Dumb Money.
I mean, I think the phrase dumb money is a little bit overly disparaging of retail investors. Like you and I, we're retail investors. Is the smart money, the institutions, are they really that far ahead of us? I noticed that SPACs, special purpose acquisition vehicles, are also making a comeback. You could say this is the kind of insider version of meme stocks, no?
Yeah, I think what's smart about smart money is that they fail to do their job but get paid millions anyway. I think that's what's really smart. But SPACs, yeah, this was a fad that came and went and now it's come back again. So the idea is that you give your money to someone who you respect as an investor, but they haven't told you what they're going to invest in yet. So it's like giving them a blank check. You get some yield in the interim while they hold your cash. And then hopefully they'll buy something super duper and it'll have huge returns and everything will be great.
I guess the key is it's a backdoor for companies to list on the stock market without IPOing, right? These SPACs are listed, they gather up a lot of investor money, go and target a private company which they believe in or think they can add value to, and then do a kind of reverse IPO, right? Where they buy it and subsume it and then it's listed already.
Now, from the point of view of the company which gets absorbed by the SPAC and bought by the SPAC, it can be interesting. They won't have to pay huge fees to a company, an investment bank, in order to list on the exchange. That's one of the benefits.
You might also get a premium price, right?
It's possible.
Because these things happen at times of euphoria, typically.
Yeah, that's true. And I think the other point is that it's often specialist investors who run these SPACs. They'll have special interests. For example, they might buy restaurants, they might buy tech companies. So you know roughly what they're going to buy often.
If you look at the history of SPACs, I don't think they've generated a good return typically for the people investing in the SPAC.
Which is, after all, the point of it. So I think that's the real problem. And I remember the FT during the previous SPAC fad, they tracked performance for various SPACs, and it was very unusual to find ones which had performed well. And usually one sign that we're in some kind of mania is when the UK regulators approve something. And of course, they approved SPACs just as the market was imploding last time. So we can have them now.
We have had them. They've not done well. So it'll be interesting to see when the UK approves crypto ETFs. Maybe that'll correlate with the top of the market. We'll see. But to zoom out again, we've touched on the fundamentals. The valuation of the stock market is expensive in the US. We've looked at the sort of retail sentiment around crypto and SPACs and meme stocks. Again, that looks like the kind of thing you see at the top of the bubble. But I think you can go even further. Like, you see some sort of mad stories in the press. Here's a headline from Bloomberg just a few weeks ago. Startup backed by Reebok co-founder to design shoes in space. Here's the opening paragraph here for you, Roman. A footwear startup is teaming up with two space companies to design a shoe in orbit as part of a mission to make artificial intelligence and blockchain less expensive and more eco-friendly than it is on Earth. How could you possibly write a better opening paragraph with more buzzwords in it?
But that's the worrying thing, I think, which is when you have these credulous investors who are willing to throw money at some kind of IPO just because it's got the right buzzwords in it. We saw this in previous rounds of meme crazes and bouts of euphoria. Everyone remembers the crazy stocks that rallied during the dot-com bubble. And institutions are prone to this as well. During 2007, I still remember some of the crazy credit products that were being thrown around. Collateralized debt obligations, and then collateralized debt obligations squared, where you've got collateralized debt obligations of collateralized debt obligations. Crazy stuff in retrospect. But while you're in the midst of the bubble, it all seems to make sense.
I think you see some of that now around AI, where I saw, for example, OpenAI is buying Johnny Ive's startup. He was the primary designer at Apple under Steve Jobs. obviously a talented guy, has been behind the leading edge of consumer products for a long time, but they're paying $6.4 billion for his startup, which I don't think has a product or revenue or anything really. Maybe it'll pay off. Like, obviously, they're going to launch some product together. Let's see. But I think the frenzy around AI has got a little out of hand. Like, I believe it's going to be a revolutionary technology. In some ways, it already is. But does that mean Mark Zuckerberg is justified in offering $100 million salaries to try and tempt away AI researchers from OpenAI or DeepMind or whatever? As good a coder as you might be, $100 million seems a lot of money.
Yeah, we're talking about crazy money, and I think no technology would really be able to justify that kind of salary.
Yeah, I don't know how it could possibly justify it. Like, I think the only way really is if Zuckerberg is sitting there thinking AI is going to eat everything. It's going to take over everything. And if we don't get to the front of the pack now, then it's too late.
Yeah, they think it's a binary outcome. Either we're ahead of the pack and we succeed, or we're not and we fail. This could be their Kodak moment.
I think an interesting question, maybe a provocative question, is if we are in a bubble, as we said, we never quite know, but if we are, and we look back in 10 years' time, what do you think will be the company that is seen as synonymous with this bubble? So if you look at the .com bubble, you could probably say pets.com was synonymous with it, right? An online pet store, billions of valuation, not much in the way of revenue, went bankrupt. In the financial crisis, you'd probably say Lehman was the one that was synonymous with it, right? A massive investment bank which went pop and triggered a lot of chaos. What do you think it might be this time?
For me, the one that really stands out is strategy, previously MicroStrategy. I think a company which is, on the face of it, an IT company, which is what MicroStrategy was, really shouldn't be parking their money in Bitcoin. Are you a hedge fund or are you an IT company? And we're getting all of these other companies which are doing the same thing. Nominally, they may be in one sector, but effectively they're becoming hedge funds. And everything's fine while the music keeps playing, but at a certain point, the music stops playing. And that's when we sweep away all of this rubbish and we get back to fundamentals.
Yeah, it seems that the IT service part of the business is not very significant now for strategy. It's an all-in bet on Bitcoin prices going up. I also look at companies like Palantir, which is a technology company of sorts, with Peter Thiel, the famous investor, backing it up. But I'm never quite sure what they do. They seem to sell AI solutions and software solutions to big institutions and governments, but it's trading at a forward price to earnings ratio of almost 300. It's hard to see how it's going to justify that.
You could say Tesla's another one, but of course there the price has already tanked hugely, largely because of the spat between Trump and Musk, but also because it's made promises which I think it can't deliver on, and other EV companies have moved into its space and just delivered what they're supposed to, which is EV cars, which are very good.
Yeah, it does seem like Tesla is the first of the magnificent 7 companies to crack. And we know how important those 7 companies are to the overall stock market and how important their earnings are. Now, Tesla's had an atrocious couple of quarters, but the other companies still seem to be delivering the profits required. Google had good results last week. We've got more coming up this week with Microsoft, Amazon, Apple and Meta all reporting results.
And it's probably worth mentioning that Tesla's still on a 159 times forward multiple. Now that's off pretty bad earnings in the future, but people are still willing to pay a huge premium for its stock.
Musk keeps promising robo-taxis and robots, right? It's got to deliver them soon, I would have thought. But is the broader point here, if you think things are expensive in the stock market, and you're like, well, why is this bubble potentially staying inflated? Well, if those biggest companies keep delivering strong earnings growth, it can keep going, can't it? It can keep going for a long time.
Yeah, while the narrative continues, while the music keeps playing, as people say in the industry, you've got to keep dancing.
Nvidia's worth $4 trillion now. It wasn't that long ago that we didn't have any trillion-dollar companies. I think Apple was the first to make it there in 2018.
That's exponential growth for you. So let's take a step back and think about what could cause a problem for this narrative, this AI narrative, but also what could eventually make the bubble pop. Usually, there are certain shocks which are fairly reliable indicators. One of them might be that the government in the US realizes that their largesse, largely funded with treasuries, is going to have to end, that their debt will have to become more sustainable, and that they're going to have some cut back on their spending. And here we're talking about a significant cutback.
Not happening right now. The latest tax bill passed, the one big beautiful bill, only adds to the deficit.
Exactly. So that's not going to get ticked on our checklist. Another thing might be some kind of natural disaster. It could be a pandemic. It could be some other form of disaster. It could be a war. Anything which deflates the enthusiasm bubble of people investing in equity. That itself is unpredictable. We don't know if that's going to happen. Or it could be that the central bank shocks markets by becoming more restrictive in its policy. That's usually data-driven, so it could be an inflation shock, which makes that happen.
But again, at the moment, the push is very much to lower rates, at least from the White House. Doesn't seem likely to happen immediately, but that seems to be the direction of travel. Remember, Trump gets to appoint the next Fed chair in less than 12 months.
Or there's some kind of massive scandal. For example, it could be that there's been huge fraud at one of the large US companies, and a lot of the rally that we've seen so far turns out to be based on a pack of lies. So here I'm thinking about something like the Enron scandal. Another one that people have attributed to popping bubbles in the past would be WorldCom. But these kind of scandals, because these are very famous companies and they've been at the forefront of this charge into a new technology or a new type of finance, they've been very influential.
Or maybe investors just, for some reason, come to their senses all of a sudden. Like the dot-com bubble didn't have much of that, right? It wasn't really popped because of any of those things. It wasn't fraud, it wasn't a war, it wasn't really rates going up sharply. It was just that the bubble had got too big. And once prices started going down, it fed on itself.
Yeah, ultimately, these things which are based on human behavior, you can't predict. I think things like the Enron scandal probably contributed to the popping of the dot-com bubble, but it's impossible to say.
To me, it feels like we're in a situation where a lot of the moving parts of finance, like the building blocks, are kind of changing. Certainly global trade is changing. Crypto's becoming bigger and bigger. Probably not systemically important, but it's creeping up in that direction. The shadow banking sector is incredibly important versus what have been heavily regulated Wall Street banks since the financial crisis. I just wonder if the regulators are on top of all this stuff underneath the surface.
They try to be, but they always regulate based on the previous crisis. So I think seeing all the moving parts isn't possible until the ball of string starts to unravel. For example, one thing might be all these stable coins, which actually buy exactly the same stuff as money market funds. One of the things I pointed out in the past is if you get a big outflow from the stable coins, that'll cause a problem and it'll cause shock waves in the safest space in investing, which is money market funds. So I think these kind of interconnections may cause problems down the line. And deregulation is a fairly regular contributor to crises. Usually it follows about 5 years after the deregulation.
So as we said at the start, who knows when this might end? But it seems unlikely that we're in a new normal where valuations are just going to be higher forever. In the short term, though, for the rest of this year, it seems like a lot of the things that were on the table as potential triggers of a crash have subsided. So inflation looks relatively under control for now. The trade war seems to be easing. I saw that Europe and America have just announced a deal. There's more discussions going on with China, but that looks to be heading in the same direction. Obviously, tariffs will be higher than they were before, but not at the catastrophic levels that people feared. The conflict between Israel and Iran seems to have settled down for now. A lot of these things that people were pointing at, we were pointing at and saying, well, they could be risky, have taken a back seat.
Yeah, I think whenever you're thinking about these tail risks, it's always good to remember that the default is that things are okay. And that really should be your philosophy of investing, because most of the time things turn out fine. That doesn't mean you shouldn't hedge your portfolio. Obviously, you should take the amount of risk you're happy with. But should you always think there's a disaster around the corner? Well, probably not. Now, if you're feeling nervous about markets and you wanted to discuss it with other people, a great place to do that is our chat forum, and you can talk to other like-minded investors there. To learn more about our membership, just go to pensioncraft.com/membership.
Okay, today's dumb question of the week. What is a gamma squeeze? So we talked about a short squeeze and how that played out in the meme stock phenomenon. What's a gamma squeeze then? This sounds even more technical.
It is a bit more technical, and it relies on the fact that there are lots of options which people have bought on stocks. Now, if you think a stock is going to go up, you could buy the stock. That's the easy way. Or if you want more bang for your buck, if you want leverage, you buy a call option. So instead of paying $100 or whatever today for the stock, you'd pay maybe less than $10 or even less than that. And then if you're right and the stock goes above the strike price of the call option, then you make a lot of money and it's levered. So let's say there's a meme craze right now for Krispy Kreme. Well, you could buy options on Krispy Kreme and thousands of other investors would do the same thing. So far, so good, right?
Yeah, except I'd get it wrong and get a donut, literally. And figuratively, a big zero.
Well, think about the people who are taking the other side of the trade. When you buy a call option, an investment bank is selling you that call option, which means you're long the call option, they're short the call option, which means they're short the stock.
Right, I follow that.
And just like a short squeeze, in order to hedge their position, if the stock price goes up, the investment bank has to buy the stock. So we're back in the situation we were in before.
And is the key point here that the investment bank, the market maker, does not want to take a directional bet? They will always try to perfectly hedge their exposure in the options market.
Now, if you hedge, that's absolutely right. You don't have a directional position, but you have something left over, which is called gamma. And if you sell a call option, you're short gamma. And as you're just about to approach the expiry of the option, gamma goes absolutely crazy. It's called pin risk. And at that point, you may have to buy stacks of the underlying stock.
All right, this is where you've lost me, Robin. You said, even if you hedge it all, what you've got left over is gamma. That needs something else to satisfy me, please.
Okay, so if you buy a call option, the actual payoff you get before maturity is like a kind of hockey stick shape, yeah? Which is curving upwards. As the price of the stock increases, the value of your option position increases. The market maker has the opposite position, so it's a hockey stick which is pointing downwards on the right-hand side. So to hedge that, they have to buy the stock, and so it levels it up on the right-hand side. But by doing that, the left-hand side kind of falls, and what you're left with is an upside-down smile, a grimace. And that's gamma, negative gamma.
So as the stock price is moving around, it can force the market makers to buy stock.
Exactly. And when the stock price goes up, the way you get rid of that newly short position is to buy back more stock. And that's because of gamma.
And this happened in the GameStop rally. That was largely done by retail investors through the options market. And these market makers added fuel to the fire by having to buy stock as the price went up.
Yeah, previously we talked about the snow that was added to the avalanche from hedge funds that were short. Here it's the investment banks which are effectively short the stock because of the short call option positions.
It seems like financial markets have these inbuilt feedback loops just by the way they work, really. So you can see why retail investors think they might win by all banding together and going up against the institutions.
But in reality, it's always problems like liquidity or the market maker not making a market during these crazy market conditions. That can really screw you up. So what seemed in theory a really good idea, in practice goes horribly wrong.
The regulators will step in before you bust all the institutions. Don't worry about that, even if it was possible.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.